Hi, I'm Tony Constantine, an investment advisor representative with Lifemark Securities Corp. Today, we've got a lot of stress out in the economy. We've got high inflation, we've got interest rates rising very rapidly, and we're in a bear market, and a number of other problems as well. What I find difficult to believe is the number of people who commit self-sabotage when we get into times like these of economic stress. Now, you don't have to believe that there's a lot of people out there, but the fact is, there are, and yes, they are committing self-sabotage. And you may be one of them. You may not realize it, but you could be. Anyway, there are 5 ways that you can prevent yourself from becoming self-sabotaged. Okay, first, you can understand that volatility happens. Volatility is the rapid upward or downward movement of stocks in the stock market, or prices in the stock market. Well, right now we're talking about volatility in a downward direction, and it's going down, has been going down pretty fast lately. The best thing you can do is stick to your plan. That'll help you get through it and come out ready to take advantage of opportunities at the bottom or at the end of the bear market. Second thing you can do is avoid the headlines. Ignore them. Don't pay attention to them. What the headlines do is attract your eye. So they're going to be as gory as possible so that you want to read the story and find out what you can do to save yourself, which is usually not much. And hopefully your eye will drift to other parts of the page, look at an advertisement or two, and maybe even buy a product or service from one of their sponsors. Yep, that's what newspapers do. They sell ad space. Hopefully you'll buy from their sponsors and they'll continue having that sponsor for a while. Okay. Number 3 is avoid the gurus. Ignore them as well. They're the people who try to tell you what's going to happen tomorrow or next week or next month. Unfortunately, there are no crystal balls. Nobody knows for sure what's going to happen or when it's going to happen. They've got a lot of reasons for maybe thinking something's going to happen and when it might happen, but nobody knows for sure. Okay, so anybody who's trying to tell you with a very hard line sell that something is going to happen, you're better off ignoring them. Okay, just stick to your plan. The fourth thing, if you do make a move, make sure you plan it out in detail, exactly what you're going to do and why, and when you're going to do things. Here's the example of what not to do. You decide that you're going to do some tax harvesting. So you're going to harvest losses and gains so that you can play the game of comparing your losses with gains so you don't have to pay income tax on the capital gains. Well, that'll work. Unless, of course, you make the mistake of panicking a little bit because what you sold for a loss starts going back up and you want to take advantage of that. You have to wait 30 days after the sale before you can buy it back. Otherwise, it's termed a wash sale. In a wash sale, you cannot deduct the losses that you harvested, and you can't pit them or pair them against the gains. So you're going to pay taxes on the gains without the benefit of writing off the losses. Okay, so you have to avoid those wash sales. So all that goes to tell you is that even more seasoned investors can make a mistake. Okay? So plan it out, stick with your plan, which brings us to number 5. And I've said it 4 times already. Just stick to your plan. Well, that only works if you actually have a plan. So if you don't have a plan, and by plan I mean a professionally created plan, because it normally comes with an advisor with it. If you don't have a plan, get one. That's the best way that I'm aware of, and I've seen many, to get through by mitigating your losses on the way down and being prepared to take advantage of the opportunities when the market turns around again. Come back next week for our next exciting adventure in investing. Until then, make every day a great day.